All right, what's going on, everybody? I am here late night at the office. I'm kind of going over in real time what my thoughts are down on paper, pros and cons, going through this 50-year home loan proposal. I have been going back and forth. It's been about, call it 24 hours since they proposed this or put this out on social media. I've been crunching numbers, been thinking about it. I had some thoughts and I kind of just wanted to discuss it with you. At first, I was like, this is ridiculous. Then I was like, this is a great idea. And now I'm kind of somewhere in the middle and I kind of wanted to just discuss with you. Let's go over pros, cons. Does this make sense? When does it make sense? Because I think there is a situation in which it might be a good idea for some people. And so let's just kind of go through that. Let's keep it very simple, stupid, right? Pros, lower monthly payment, right? So the way to think about this is that the concept, again, at the time of this recording, there's no official proposal on what the actual interest rate would look like. But if we're to use some logic in the situation here, let's assume that it has to be a higher interest rate than what a 30-year fixed is going to be. For the sake of me crunching numbers this evening, I was running everything from the perspective that if right now I could get a 30-year fixed called conventional loan at around 6.2%. I ran everything from the perspective that the 50-year would be around 6.5. I even also ran it from the perspective that if they somehow made it an incentive where they said, hey, we're going to match the 30-year fix, which I don't even know how that'd be possible from the lender's perspective. But let's say they somehow did approve of that. I also ran it through that perspective too. But I ran through both scenarios. Ultimately, in either capacity, even if it matched the 30-year fixed or was even higher at that 6.5 that I'm running, it is a lower monthly payment. So, I mean, that is a pro, right? Easier qualification when we come down to, debt to income ratios and just being able to qualify for a loan based on what you're making and what your existing debts are. If you have a lower monthly payment, in theory, there are going to be more people who can qualify for the loan. That's the second pro. Third pro, again, since this has all just been a soft proposal thus far, I haven't seen anything down on paper of who would be allowed to take advantage of this loan. Is this going to be something that is available only to first-time home buyers to help them get into homes easier? Or is this going to be open to any and all kind of buyer, including an investor? Where my mind goes in this regard is for an investor, does this allow for more monthly cash flow? It's been really tough the past couple of years to underwrite certain rental opportunities. Does this make it easier for allowing a more monthly budget for buying a rental property? In the same kind of vein and capacity from an investment perspective, if I'm saving on the monthly payment, do I now have the couple $100 extra per month to go invest that into another type of project? That's kind of my list of pros so far as the bullet points. Let me go over the cons, and then we're going to kind of dive into some more specific considerations. Cons, way more interest. I think this is probably the prevailing tone if you're looking at social media at all right now is, oh my gosh, the interest that you're going to pay. These banks would be laughing, they'll be in their groups and in their congregations just licking their chops and thinking how great it is that people are paying a ridiculous amount of interest over a 50-year period. In a typical, calculation, it's essentially like double what it would be over a 30-year payment. So I'll go over some specific numbers here in a bit, but essentially just know that the interest that you're paying is pretty close to double what it would be otherwise. Higher interest rate. I kind of mentioned this earlier. I have to imagine applying some logic here that they're going to have a higher interest rate to be able to make this loan work. I don't imagine a world in which it's going to match what the 30-year fix is going to be. So con, you're going to be paying a higher interest rate. Lower equity with the traditional appreciation rate. So if you think about it, when you're paying off a home loan, very beginning of, called the first decade and first, stint of the loan, largely what you're paying down is actually just the interest, right? You're making very little payment towards the principal balance of the loan. You're paying mostly interest. In this capacity, you were paying even less principal and even more interest on the loan. So let's say if we fast forward 5 or 10 years, your principal payment or your principal balance has been paid down less and you've been paying mostly interest up to that point. So if you had to say, for example, sell the property 5 years into it, your equity position, if we're assuming a standard appreciation rate, meaning year over year, your house has increased in value at a, call it standard rate, historically speaking, for what I'm running in my calculations in America since the early 1990s is about 4%. Now, we've had some outliers the past couple of years because of the pandemic and the market that arose from that. But if we're going back that far, it's about 4% a year. If we're assuming that annual appreciation rate, you have less equity at the time of if you were, for example, selling the property in a 5 or 10 year window. Being a debt longer, if you are the individual who gets duped into this loan and you end up having to pay for 50 years on this house, I think that's a shame on you. And that's the worst outcome in this regard. That would be the overall prevailing narrative is don't be the person who gets the 50-year loan and actually pays on it for 50 years. That'd be atrocious. That's horrible. I hope that actually doesn't happen. But for the sake of an example, let's say you're 40 years old right now and you bought it and you pay on this for 50 years, you're 90. And ultimately by that point, you're hopefully long since retired. But even getting into retirement, like you can't enjoy your retirement properly because you're still paying on this ridiculous loan. So that's horrible situation. That's like the worst case here. Something else to consider, and this is just this is conjecture. This is just a throwing thoughts out there. If more buyers can qualify, but inventory doesn't keep up along with it, then the prices can just go back up. More demand, still the less supply. Ultimately, the less supply becomes more valuable. Also, I have to imagine that there's going to be stricter underwriting from the lenders. So like for some perspective, anytime you're buying a house, the lender is going to do typically an appraisal on the property. They're going to say, hey, we want to determine what we think the property is worth because we're giving you such a large loan. In the case that you default on the loan or you don't make the payment, we have to take back the property. We actually want to make sure that we can sell it for what we're ultimately trying to lend you for, right? I have to imagine in this capacity that there's going to be even stricter underwriting guidelines to be able to qualify for the loan because it's such a longer investment and there's such little balance that's going to be paid on the loan. If you were to default on that for any reason, when the bank takes that back over, if you haven't paid any of it down, then essentially they're stuck in a position where they can't sell the property and make money on it. And the bank's always going to view that as a big no-no. So that kind of goes through my pros and cons list here. I do want to kind of cover who would this actually make sense for, and then kind of go over some numbers with you. Who might this make sense for? If you are someone who is trying to get your foot in the door, meaning that you have not been able to, you're a first-time home buyer, the prices have been really egregious, you haven't been able to find that property where you qualify or be able to purchase your first home, this could be an option where you can get into the property. And then the game plan would be don't be the person that pays on it for 50 years, but in 5 to 10 years, refinance the property into a more traditional either 30-year loan, a 20-year loan, or a 15-year loan, where you can start to actually pay down that balance in a more realistic timeline. So let's say, for example, 5 years from now, you're in a better job, you got a raise, you're making more money, you've paid down some debt along the way while you're living in the house, you've gotten to a place where it's more, you have paid down a little bit of the balance. And so when you do refinance, you can take some of that equity that you've earned out and then ultimately refinance it into a more traditional payment where you're going to pay it off in a more realistic time. Another person who I see could benefit from something like this program would be buying an undervalued property, fixing it up and refinancing. So if you were going to do almost call it like a live and flip scenario where you're going to move into something where it needs work done to it, you know that you're going to go in and you need to put some TLC. Hey, maybe that extra monthly cash flow, that savings could be applied towards the rehab of the project. And ultimately the same scenario, if you're going to live there for the longer term, ultimately refinance at some point. When you have that refinance done and the property is worth more, you're going to get more equity out of the property. And so I could see a scenario where some people take advantage of that, or even just going to, sell the property further down the road. If you fixed up the property, you added value to it, you took, let's say, a $300,000 property and through some love and labor, you made it worth a $400,000 neighborhood. And now it's, worth that much more. Then I could see that making sense because it really doesn't matter if you've only paid down a little bit, you added the value that, you've got it back up to speed. And therefore you're going to cash in on that that equity or that value that you've added to it. The other thing, and again, this depends on if this is only going to be exclusive for first-time home buyers or investors, is just the concept that can I now, if I have more monthly savings on a cash flow basis, could I then go invest with that savings to get a higher rate of return than, I would otherwise. So if I'm saving $300 a month, but I have 3 or 4 properties that are doing this, that's around $1,000 a month that I'm getting back as far as savings go. And can I apply that towards saving for another property, for example? That's my thought. But, it just depends on if they're going to restrict this to only first time home buyers, because that's kind of the guise in which this is being floated out there, is that this is supposed to help with the affordability and accessibility to real estate. So I don't know if it's going to apply to investors or only first time home buyers. We kind of have to wait and see. At the time of this recording, it's all kind of hearsay. I do want to talk with you some numbers though, and kind of give you an idea on how this might make sense. So give me a second here. All right, so I got ChatGPT open here. And just so that way you have some context on this thread I've been going through with it. I have been working through this scenario. If I'm assuming that I'm purchasing a property for the average sales price here in the Cincinnati and Dayton, Ohio area of about $300,000, I'm assuming that I'm a first-time home buyer and I'm taking advantage of the 3% down program. That is a loan amount of about $291,000. That is the loan balance. I'm assuming that the house is going to appreciate at about a 4% rate. That is the historic average. I'm assuming that if I were to sell the property before that 50-year term came up, in this example, I'm looking at this from the perspective of a 5-year and a 10-year window. I'm assuming that I'm going to have to pay 7% of the sales price to cover the costs of selling the property. This could be, for example, you're selling it and you're using a real estate agent. If the real estate agent is helping you sell it, typically the commission's based upon the purchase price, or the sales price rather. And then same thing if you're offering a co-op to the buyer's agent, and then all of the costs associated with the title company and getting everything transferred. A general rule of thumb might be about 7%. It's not fixed. I feel like the legal team wants me to say that. It's not fixed, but I'm just giving you a general guideline here. I'm also then running it from the perspective of, hey, what if I were to rent a $300,000 house? I'm going to assume that's about $2,000 a month. And let's assume that that rent were to increase just 3% a year annually. Okay. So with that in mind, the $300,000 house at a 4% rate of appreciation after 5 years is $364,000 and some change. 10 years, that's $444 and some change. Now, the balance of the 50-year mortgage, assuming that it's a 6.5% interest rate, after 5 years, that remaining loan balance is $286. After 10 years, that's $280. So, just to make it very clear here, after 5 years of payments, you're only paying down $6,000 in the principal balance. Again, if we go back to what it was initially, it's a $291,000 original loan. And after 10 years, we've only paid off $11,000, which on paper sounds pretty abysmal. But let's actually crunch the numbers here, because we got to keep in consideration that the house has been appreciating, right? So what is the potential net equity after selling, including those 7% in selling costs? After 5 years, assuming that the property was worth $364,000, with your remaining loan balance, that's still a net equity position of $52,000, almost $53,000. In 10 years, that's $132,000. So that's after subtracting the loan balance and the selling fees. So that would be like your potential take-home pay. That would be your equity if you were to sell the property after that 5 and 10-year time frame. So if we were to compare these different scenarios side by side, a 30-year fixed at a 6.2% interest rate, your net equity after 5 years is $67,000, almost $68,000. So of course, it's going to be more than what these 50-year options are going to be, right? Same thing with the net equity after 10 years. It's about $30,000 more in the 10-year time frame. Again, if we look at this from the perspective of renting, of course, you're getting none of that back, right? So that's net equity zero. And then if we look at the total cost of what that renting would have been over 5 years, assuming that $2,000 a month appreciated, or I should say, went up in cost 3% a year. Over 5 years, you've paid $127,000 in rent. And over 10 years, that's $275,000. You almost paid for the whole house over a 10-year time frame. So even though the 50-year option builds at a much slower equity pace, you're still outpacing the fact that you would be paying rent otherwise. And I mean, you're still talking about getting some real gains from the property if you were looking at it from the perspective of, this 5-year or 10-year time frame. I think what a lot of people will end up doing is they'll use this loan as a stepping stone. So I'm going to get into the property and be able to, at least start to ride some of the gains of, real estate appreciation and then refinance out of the loan. So let me know what your thoughts are. I know this is a lot to take in and we're all kind of digesting this in real time. So I'm sure shortly after I post this video, there's probably going to be things that are subject to change, but I'd love to have a more in-depth discussion with you on if this is something that you know you're passionate about one way or the other. I think this is phenomenal, or I think this is going to be detrimental to the economy. I want to hear both of those perspectives. So do me a favor, email me. My email will be in the description, but it's Trevor, just my first name, Trevor, the number one at kw.com. That's the best way to get a hold of me in the fastest way. But I would love to connect with you if you are here in the Cincinnati and Dayton, Ohio area, or if you're elsewhere in the country and you have some thoughts and you want to chime in on it too. I would love to hear that as well. So let me know what your thoughts are, and I will talk to you here soon.